Hey, this is Michael. Welcome back to me and Paul's channel. In today's video, we're going to talk about HELOCs, home equity line of credits, and can you use them to purchase investment properties? But first, let's define a few terms. How do you get a HELOC? So first is, do you have equity in your current one of your properties? Like for example, for most people, it's their primary residence. So let's just say the house you live in today, currently as is, we were to sell it today, is worth $300,000. And you may have a loan on it for $180,000. You then have $120,000 in equity. That's the 300 minus 180,000. Now, if you go to a bank and you want to tap into some of that equity to use it, we'll kind of cover examples in a second of what you can use it for. The bank will look at it, you sign a bunch of paperwork, they'll send an appraiser out to your house to make sure the values make sense. And they might decide that, hey, you're eligible for a $100,000 home equity line of credit. The interest rate is tied to prime. The definition down here on what prime is, it's essentially it's a benchmark rate used by the banks to set home equity lines of credits and use it for credit cards as well. And some lenders on home equity line of credits might charge a spread as well. They might charge, for example, if the Fed funds rate is currently at 3%, and they might charge 100 basis point spread on top of that, which is 1%. So you'd be paying 4% interest on that. So in this example, let's go back here. You have a $100,000 HELOC, costs you 4% a year when you're using it. If it's just sitting in your account, not doing anything, you don't pay any interest. So when you take money from that, it's 4% will be applied to the balance that you took out. In this case, if you took out the full $100,000, you're going to be paying about $4,000 in interest only over the year, or $333 a month. Now let's jump into, what can you do with the HELOC? It's essentially a blank check once you get it. You can use it to make home improvements, add that patio in your backyard, renovate the bathrooms and kitchens. You can use it to buy a car. So if you don't want a new car and you want a used car and rates are a lot higher, maybe you tap into your home equity line of credit for a cheaper rate and purchase it for cash the car and just pay back your home equity line of credit. Another way to do it is to use it as an investment strategy. You're essentially becoming the bank. You could use it for private lending. You could use it for rental properties. You could use it to buy, renovate, and resell other properties. So I'll kind of go into those examples now from a real estate perspective. The first one, we're going to look at it from a single family residence. So in this case, let's just say you buy a property for $60,000. It needs $35,000 in renovations. So all in, you're at $95,000. Now you could take that money from your HELOC, since you have $100K in that last example, and you could fund that entire purchase and renovation project from your HELOC. Then you factor in, if it takes you 4 months to buy and renovate it, your total interest would be $1,267. Let's assume just that you have $1,000 in holding costs during that period. So all in, when you add in the 95 plus the two $1,000 amounts here, you're at $97,267. Again, you can fund this with your entire HELOC. When you're done, it's fully renovated. You got a renter in it, let's just say. You go now to cash out, refi, and pay back your HELOC essentially. So if you were to sell the property as is today, your after repair value is now $150. You go to a bank and they say, you know what, we loan, our loan to value ratio is 70%. So the most you could take out on this property is 70% times the 150, which is 105. Now at closing, you essentially get $100,000 mortgage on the property, which then allows you to pay back this $97,000, and you walk away with $7,000 and change at settlement. So now you're into the property for nothing. You actually have a check for $7,733. And let's just say you got your mortgage amount on it is 3.5% at 15-year amortization. That's your monthly principal and interest. If you're collecting $1,400 a month, you now have about $650 a month cash flow, minus taxes, insurance, and repair estimate, renovations for the future, reserves. So that's a great example of getting into a property using your HELOC and basically owning it, free, well, not free and clear, but you basically walk away with money on the deal at settlement and collect the cash flow going forward because you recouped all your initial investment. So that's just a rental perspective. If we look at it from a buy, renovate, and resell perspective, let's just say you purchased a property for $52,000. It needs $45,000 in renovations. You got transfer tax, closing costs, and this just gets you to $99,000 and change. You could borrow from your HELOC that $100,000 and fund all this. And then when you're ready to sell it, you could sell the property for $150,000 This is, you're paying back your initial investment from the HELOC, from the number above. You're going to pay yourself back that interest on it. You have holding costs associated. You pay a realtor. You have transfer taxes. You have closing costs, and you walk away with $37,000 in net profit. So not only did you borrow cheaply from your HELOC, you're able to purchase this, buy, renovate, and resell. You pay back that HELOC, so you're earning zero interest on it now, and you collect the check for 37 and change on a buy, renovate, and resell opportunity using your HELOC. And then the final example is if you don't want to do renovation work and all that other things that comes with rental properties, become the bank. Private lending, there's people with deals that need money all the time out there. One example is you could be a mortgage note on a flip property, for example, where you have a 100K HELOC, your borrowing cost is about 4%, or on an annual basis costs you to borrow that money $4,000 a year. Now, if you're lending on continuous fix and flip projects at 12%, let's just say, you're earning $12,000 in interest a year. So you become the bank. Your net interest margin is the $12,000 you get from your real estate lending minus the $4,000 you have to pay to the bank for using the HELOC. So, that can pay for a vacation or whatever, add it to your retirement fund or whatever else may be. It's just another way to use your HELOC from a private lending perspective. And then you could also use it. It doesn't have to be a debt structure. It could be a JV kind of equity split structure. On the profit above the deal above, you could have maybe borrowed, you could allowed someone else to maybe do all the work. You put in the money, and then you would have split this profit with them instead of treating it like debt on the example below. So hope this video was helpful. If it was, smash the like button. Have any questions, write them in the comment section below and we'll answer them. If you haven't already done so, please subscribe to our channel. Thanks and have a great day.